Today we're discussing 4 investing principles. There are 4 key principles to keep top of mind when investing. The first principle concerns protection. Protecting your money while investing is essential to manage risks, combat inflation, and ensure long-term financial security. By implementing strategies like diversification, insurance, and maintaining emergency funds, you safeguard against market volatility. You prevent forced selling of assets at a loss, and you preserve your capital for future goals, such as retirement. Let's look at the key reasons to protect your money while investing. First, it manages risk and volatility. Diversification, that is, spreading investments across stocks, bonds, and other assets, reduces exposure to any single asset's downturn. You prevent capital loss. Proactive protection strategies, such as keeping a portion of the portfolio in cash, allows you to avoid selling investments during market dips. Combat inflation. By protecting money, you're really keeping it from growing faster than inflation, which reduces purchasing power over time. You need to ensure long-term security. A solid protected portfolio guarantees that you can meet retirement needs and maintain your lifestyle, even when unexpected events occur. You'll want to maintain financial control. Insurance and legal safeguards protect your assets from lawsuits, fraud, or unforeseen crisis, ensuring that your wealth stays in your hands. And you avoid emotional decisions. A well-protected diversification portfolio minimizes fear during market crashes, allowing investors to stay committed to their long-term plans. Effective, proactive measures ensure that you do not lose what you have already worked so hard to accumulate. The second principle addresses liquidity. Liquidity is crucial in investing because it allows you to quickly convert assets into cash with minimal price impact, providing flexibility, security, and the ability to act on market opportunities. It ensures that you can meet short-term financial needs, avoid forced sales at losses, and maintain portfolio stability during market volatility. Let's look at some key reasons why liquidity matters. First, you get fast access to cash. Liquid assets such as stocks or mutual funds can be sold swiftly, ensuring that you can access your money for emergencies without significant delays or penalties. Preventing losses. Illiquid assets, like real estate, take longer to sell and often require lowering the price, which can lead to selling at a loss. High liquidity means a narrow gap between buying and selling prices, such as the bid-ask spread. Flexibility and opportunity. Liquidity allows you to rebalance your portfolio or seize new investment opportunities immediately, rather than waiting for funds to become available. Price stability and confidence. High liquidity markets may have many buyers and sellers, which results in more stable and transparent pricing. Risk management. It protects you from the risk of being unable to exit a position during a market downturn. Now let's consider the third principle, the rate of return. The rate of return is the principal metric for measuring the percentage of gain or loss of any investment over a specific period, acting as a report card for performance. It is essential because it allows investors to compare different opportunities, track financial progress, and determine if they are meeting their goals. Let's consider some of the key reasons why rate of return is so important. First, performance evaluation. It directly shows how hard your money is working for you, revealing if an asset has gained or lost value over time. Comparing investments. It enables investors to easily compare different investment vehicles, such as stocks, bonds, mutual funds, real estate, segregated funds, to identify which opportunities offer better returns. Tracking progress. By analyzing the rate of return, you can track whether you're hitting long-term financial milestones and adjust accordingly. Understanding your rate of return is essential for maximizing growth through reinvestment, allowing you to earn returns on your returns. Risk assessment. It helps investors compare the returns against the risk taken. It is important to note that while rate of return is crucial, it should be used alongside other metrics like risk, tax efficiencies, and investment time horizon. And now the fourth principle, taxation. Taxation consideration is crucial when investing because it directly impacts your net after-tax returns, often accounting for a difference of nearly 2% or more in annual performance. Proper tax planning helps maximize your wealth by minimizing the tax liability on any investment income, such as interest, dividends, or capital gains. Here's some reasons for considering taxes in your investment strategy. Maximizing after-tax returns. Taxes are significantly a drag on performance. Account selection. This is asset location. Using registered accounts like TFSAs or RSPs protects gains from against immediate taxation, allowing for faster compounding. Different taxation types. In Canada, interest can come from fully taxable, while capital gains and Canadian dividends receive more favorable, lower tax treatments. Tax loss harvesting. You can sell losing investments to offset capital gains on profitable ones. This reduces your overall tax burden. Preventing unnecessary tax bills. Purchasing mutual funds just before they distribute capital gains, that is, near year-end, can result in paying taxes on returns that you didn't experience. Understanding these factors helps in creating a more efficient, higher-performing portfolio over the long term.